Cord to this computer. Hello, everybody. Welcome to the third episode of Trading the Absurd with Greg and Sterling. Please note that this podcast is for educational and entertainment purposes. We are not giving investment, tax, legal, or relationship advice. So today we are talking about tokenization, which is it's putting an asset onto the blockchain, and it's something you've probably heard quite a bit of recently if you follow news on crypto. My background is asset-backed securitization, and tokenization appears to be very similar to this in that you are taking either an asset or assets, and then you are dividing it up and selling it off to investors. But it is done on the blockchain as opposed to being records being kept by a variety of other third parties, which is the way it is done normally today. So away we go. Sterling, how's it going?
Away we go. So we're going to talk about tokenization. This should be interesting because, as a technology guy, one of the things that always kind of sticks in my head is the more things change, the more they stay the same. And I go back to mainframes and programming on mainframes, and then when you get into things like object orientation and all kinds of crazy stuff in programming, the reality is you see that we're kind of solving the same problem using the same basic thing. We might call it something different. We might do the details underneath differently, but at the end of the day, we're trying to solve for some procedure that starts somewhere and does something or reacts or event driven. When I look at tokenization, the questions that kind of come to my mind are around all kinds of things about, well, how does this compare to other models and why would you do this versus doing the other things, right? So, my understanding of tokenization is we're taking a real world thing, we're creating a token of it, which, a real world thing can be any asset for the most part, up to and including, I guess, Hunter Biden's art or, Donald Trump's watches or something. But I mean, any kind of real world thing that's an asset, and then representing as a digital token on a blockchain. And everybody always gets excited about the blockchain, and I find that very, 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 very few people actually understand the blockchain. But the physical asset and legal ownership, are all effectively represented by that, right? The record is the asset, is kind of the idea. And I get that, we're different than a mutual fund or an ETF or even other things that divide assets like timeshare or fractional ownership. But understanding kind of why you do that, why you do it this way, and how it actually works, of course, those are the big questions that are sort of stuck in my head. And then, the why you do it should really come down to what's the advantage. So that's kind of where I'm coming at this from. This isn't an area where I have a lot of expertise. This is an area where I understand the underlying component parts, but I don't really know exactly how this is going to market and what it's going to do.
Yeah, I agree, and I'm kind of in the same position as you are. I mean, this is, we certainly understand how deals are done and have done plenty ourselves in over the course of our careers. But this is sort of a new, I don't know, new conduit, new way of doing it. But to your point, it's the same thing that's been done for decades, for a long, long time. What is interesting about the blockchain? A blockchain is a DLT, digital ledger technology, and distributed ledger technology. And instead of there being one ledger that sits in one place with one legal entity that is supposed to keep track of everything, there are all the computers on the network get a full copy of whatever that ledger is, so that there's no single point of failure. That is one of the advantages of doing it that way. And there is a difference between assets that are native to the blockchain, and that's usually things like cryptocurrencies like Bitcoin and Ethereum. They only live on the blockchain, and it's coin is minted and then it gets it initially goes to the miner that mines it, and then they sell it off to somebody else, and the record of that coin can be tracked, forever. Basically, the records are contained in the chain, and then you have you mentioned before real world assets, which could be any number of things. Could be real estate, could be you mentioned Hunter Biden's art, and I have to wonder whether that would be more or less valuable than the digital pictures of monkeys that were popular a few years ago. That I think, forget the actress's name, but she was pitching them on some TV show.
Yeah, it's funny how much less popular his art became the day that his father stepped out of the presidency.
Funny
So
that.
yeah, funny that. I mean, people were paying $500,000 for stuff from a guy who had no background in art, which is remarkable. They talk about tokenization. He was tokenizing access and influence in the form of art, as
Yeah,
opposed to a DLT.
yeah,
So yeah, I mean, so the analogy, so it's a digital cap table, basically, a digital ledger, distributed ledger,
right.
and I get that. I mean, it's funny though because it strikes me that that also is a big invitation to fraud. If I can figure out how to manipulate the DLT, then boy, I could create all kinds of assets that are valuable, or steal somebody else's. And I realize that's what the blockchain is about, and that's what it's meant to prevent. And thus far, knock on wood, hasn't happened with Bitcoin or any of those. Um, but I think quantum computing might change all that. But that's a whole other topic.
Yeah, yeah. It is designed that to be able to do that, to be able to go back and rewrite the chain, you would have to control the majority of the network, and um, the cost of being able to do that is tremendous. It's in the many billions of dollars from the estimates that I've seen, and so unlikely to occur. I mean, there's certainly been cases of fraud and related bad actions on various parties um, over the short life of cryptocurrencies and whatnot. But the model is designed to prevent these kind of things from taking place, because if you try to make a change, everybody has to agree. That's the whole thing. If someone puts forth a transaction that everybody else doesn't agree with, that transaction is not accepted onto the chain when a new block is added, and um, that's how these things are supposed to remain secure. And for people listening that aren't really familiar with the idea behind the blockchain, one of the best analogies that I ran across was um, I forget who said this. I wish I could credit them properly, but what I remember is, what you remember, the big stone coins from Yap that are embedded in the ground, the big giant
Yeah,
stone
yeah,
coins with a hole in them.
right.
So imagine we've got a village full of people, and you got a number of these around, and every morning everybody comes out with their individual ledger and say, okay, this big stone coin over here is mine. That one over there is sterling. That medium sized one, belongs to Joe. And then one day, so you say, okay, well, last night Joe got drunk and he sold me his big coin for 12 goats and wife number three. So he's not real happy about the trade, but now that coin is mine. And so as everybody, update this so that now that you know that I own not only the big coin next to my HUD, but the medium sized one over by Joe's HUD.
Well, and I think the big thing there is, if you think about it, a ledger traditionally has been, a book, a physical book sitting in one place. That
Mm-hmm.
changed. It went to a database on a computer, but it was still a master copy of that database. And then
Mm-hmm.
somehow through the various intermediaries, right, those transactions filtered to that one place where they officially made the entry into the ledger.
Right.
So if you buy or sell or stock or whatever, whoever
Mm-hmm.
is running the treasury function at the corporation that's been, publicly held has to update that. And there's a whole bunch of things in the middle, between the brokerage, the DTCC, clearing the transaction, all that stuff happening, right? versus on the blockchain approach is there's no one digital ledger. Everybody has a copy of the entire ledger. And then when
Mm-hmm.
a transaction happens, right, there's a hash for this block, and then there's a previous hash. And then you do the transaction, and the hashes have to basically work out through the algorithm.
Right.
I get that. I understand kind of what that's doing is distributing it so that basically everybody can update it, and then everybody else gets it. So we made it a lot faster. We cut out a bunch of middlemen who are probably making phone calls and writing things down. Um,
Right.
and the hash and the algorithm also presumably improve not just the security but also the data quality, right? So you're not there, and somebody's not fat fingering it in the main thing. I get that.
Right.
Um, but then when we start talking about tokenization of assets, right, the blockchain is really how that token moves through time. If Alice sells it to Bob, right, or let's say she has 20 and she sells five to Bob, then she's got 15 left. We update the ledger to basically credit five to Bob and, debit them to her, depending whether you look at it from a bank's perspective or the asset owner's perspective, whether they're debits and credits. But
Right.
that's the basic idea, right? And so I guess so we kind of understand the analogy there. But boy, there's a physical asset somewhere behind this. And how do you keep that tied into that physical asset over time? And, like you were mentioning earlier that Barry Sternlicht's trying to figure out how to tokenize Starwood. Um, but I mean, if let's say they tokenize, I don't know, a bunch of their real estate assets and resorts and things, if one of those hotels burns down, then what happens?
Well, let's say it was in something more familiar like a REIT, right? Um,
Yeah.
so everything's going to have insurance on it, and there are going to be insurance proceeds that get paid out. So typically, the insurance proceeds would be used to repair, rebuild whatever burns down, and um, if a decision is made to not do that, then the insurance proceeds would be distributed to the people that own the asset, right?
Presumably, but yeah, the token holders would get their pro rata share, I guess.
Yeah,
Right.
and then the same thing would happen in the case of a REIT or in the case of something like a Reg D offering or um, whatever other vehicle you use this for. I mean, usually Reg D is what real estate is done with because it's the cheapest way to go about this from what we've been able to figure out. So,
And I think that's probably a key benefit, right? This go back to those axiom of finance, right? Perfect information and no transaction costs.
right,
So this is further reducing transaction costs, trying to get them as close to zero as possible.
right,
Um, and so I get how that works. But it also strikes me as it's an abstraction layer that allows for uh, you know basically people who are offering these kind of assets to investors to obfuscate and find a way to rip them off. um, Not like they don't already have a bunch of ways to do that, not like they're not really already good at it. But this also, presumably as we continue to democratize that ownership by making it smaller and smaller and smaller, we've got less and less sophisticated people who want to be buying these things and not really understanding what they're buying. Which I think is why the SEC is sort of taking, you know, the positions they are on these tokenizations. Like Sternlink was complaining that, the SEC is not going to let him do it, basically. Um,
right.
and because they're still trying to enforce securities law. And I think you pointed out regulators globally have sort of taken this approach of substance over form, right?
Right.
It's what are you buying? Not did you buy it through a token or did you buy it through an ETF or did you buy it through a mutual fund? But what is it?
Correct.
And that makes me wonder, how do you do, a whole other set of questions, right, around tokenization? What happens to all the gazillion disclosures nobody reads? Where are those?
Right. Well, um, because they're going to have to be somewhere, and the legal ownership is going to have to be conferred from whoever owns the asset first, or whoever the GP is that puts the deal together. Uh, it has to be conferred that into the token so that these rights are transferred with the tokens when they're sold. And um, you know, I'm I'm more skeptical than you are, because my view is that what the SEC is doing is they're protecting incumbents, and they're not really protecting the investor. Anytime I hear investor protection, my BS meter goes up.
Yeah,
Uh,
you and me both.
and we'll come to something on the Clarity Act a little bit later that I think speaks very directly to that. But I think, under the guise of investor protection, I think that they are just one thing, they don't want to give up control, because control over one more asset means that they still have a budget and they still get paid.
Right.
If it falls outside their bailiwick and they don't get to regulate it, then they don't get to add head count, and they don't get to, they're less important thereby. So I don't think that what they're doing is for the actual benefit of the retail investor. And I'm sure there will be, I'm sure that'll be polarizing, but that's the way I see it. So um, I, I don't know. I mean, we're both entrepreneurs with small businesses, and I know that neither one of us has tried to rip anybody off. So certainly there are people out there that do, and you've probably encountered, one or two cases of business fraud in your career, like I have. But
Absolutely.
I don't think that that's, despite, the leftist view that anybody that went to business school is evil, uh, that's not
Yep.
actually true. I think the average business person, um, wants to succeed and wants to do well, wants to do so ethically and actually create value, for whoever their customers are. And if they're smart, they value those relationships, because you can um, be way more financially successful from an ongoing relationship than you can from, selling something one off and, screwing your customer so that they never want to come back and do business with
Well, as I often say, a brand is something that you build one customer at a time,
you.
by performing. And a
Right.
brand is nothing but a promise of quality and consistency. And, sometimes that promise is that we're going to consistently rip you off. But, you know, um, let's hope not, though, right? And that's the thing I always look at is, how does this how does this create value? And I think the short answer is mostly around reducing transaction costs
Yeah.
and also basically, I guess, increasing the velocity of transactions. Um, so anyway,
Yes, I think that's exactly right, because you mentioned this earlier. It's like, instead of you know, you, a closing, being T+1 or T+2 through DTCC, it can happen nearly instantaneously. All right,
correct.
but what the SEC has done and what they've mandated is your accredited investor rules all still apply. So you've got to have basically a white list of who's eligible to buy a given security. And if you try to sell your token to somebody that's not on the list, it's not going to go through, because these um, it's able to you're able to program contracts on the blockchain, and they're kind of dumb. They don't have any discretion. They're going to do what, they're going to execute the way they're programmed to execute, or they won't. So if they don't, if the program says, go look at the whitelist and confirm this wallet address is on the list, and it's not, the transaction will get rejected. So that's again your whole, KYC, AML, know your customer, anti-money laundering,
Right.
rules that it's forcing you to comply with. But instead of it being, again, some individual at a bank or a brokerage or what have you, it's hard coded into the contract that sits on the execution contract that sits on the blockchain. So um, that's one thing. I mean, you are speeding things up. You were simplifying that settlement layer. Um, and one of the other benefits that's often touted is an increase in liquidity. But um, as long as you're maintaining the same investor rules that you've got to be an accredited investor, you're not increasing the pool of accredited investors by doing this. You're providing just kind of one more pathway for an accredited investor to invest in something, but it doesn't change what they have to go through. It doesn't change what they have to do to prove their status. And if you're not opening new markets. If anything, I mean, we're both Gen X and we're pretty technologically savvy, maybe less so than our kids, who grew up with a video game in their hand from the time they were.
Depends on your definition of technology there, but yeah.
Well,
That,
I can't. I mean,
let me put it this way: you and I probably understand the inner workings of an internal combustion engine. Um, the vast majority of kids today have never looked under the hood of a car. It boggles my mind. They just have no interest in that.
right?
And you would think that they'd be interested in that, but that was the cool technology of our time, right?
Yeah,
And so we were gearheads because we wanted to understand how it worked as much as anything. Plus, we wanted to go fast and make a lot of noise. But if
exactly.
you if you think about the technology thing, right? Being a user of technology does not make you an expert of it, and that's kind of what I find is in a lot of people who use the technology, like they've mastered social media and they figured out how to get an audience and do things that you and I don't know how to do on a podcast, right? But
Right.
how does that technology actually work? They don't really know.
I mean, that's a fair point, but I mean, what I was going to say is, let's look at our parents' generation. Let's look at the boomers, and if we assume that people um, become wealthier as they get older just because they've had more time to accumulate assets and make investments, a lot of your accredited investors are going to be older folks our age or older, and not so much the younger ones that are more native tech and crypto savvy. And it's like I can't imagine my mom or my dad opening a crypto wallet to be able to invest in some kind of tokenized investment that it's not, it
No.
would not make a difference to them whether it was tokenized or not, assuming that it's
But
the
if
same
they
set
could
of
go
cash
buy it
flows.
through their broker at, Morgan Stanley or something,
Mm-hmm.
and it shows up in their, shows up on their statement every month, they probably wouldn't know or care that it was
Yes.
tokenization. You know what I mean?
Yes, but but back to my point that this is not disintermediation. This is
Yeah.
just you're giving the incumbents a new set of technology to do the same thing they've always done with.
Yeah.
You're not disrupting the industry in any meaningful way. That's my
Yeah.
point.
Fair enough. Agreed.
Yeah.
Agreed.
So anyway, that's the thing about this. It's I we ought to do a better job of educating people when they're in high school of investments. And frankly, I don't think you should be able to graduate unless you can calculate interest on a mortgage payment. You know, I'm a finance geek. I love math, but not
Yes.
everybody is going to use algebra three. I mean, excuse me, yeah, like algebra three or calculus or um, it's the engineers will and some scientists will, but most everybody is going to take out a loan at some point in their life or have a
Correct.
mortgage. And, that just directly impacts everyone. And it's
And
not,
here's the thing that's kind of crazy about that, right? You don't have to be a math whiz to figure it out. I know a lot of salespeople who are really bad at math, but they're really good at scamming people with math, if you know what I mean. And loans are a common way they do that, right? Arbing spreads on loans and changing terms and doing things like that. So because at the end of the day, they're selling the payment, they're not selling the actual cost.
sure.
And so I agree with you. I mean, that's something people should know coming out of high school. That and insurance, understanding how insurance works and how it's priced and all those kinds of things. Probably the two, the two skills I think in life that you really have to have, but they just don't teach you anywhere in high school. And you know, you can go to college and never learn it either. So, you know, if you get a degree in social work or something, you're probably never going to see any of that. So, but everybody needs it.
Yes.
Um, so why do you think then that, you know, tokenization? Why now? Um, and what's the, you know, what are the predictions for scale, and why do they think it will scale?
You know, that's the thing is you go look at you know, what's out there in the media, and there's just you know, projections of tremendous amounts of scale, you know, for the next 5, 10 years, but I don't see how any of it happens unless the rules, you know, or the SEC enforcement rules change, because you're really not increasing liquidity. So, you know, it could be a change to, again, the status quo from the standpoint of, all right, we're going to move a lot of the back office stuff, the settlement, the servicing, you know, of cash flow payments, you know, the distribution of cash flow payments to the owners of whatever the investment is. You know, all this can be moved on the blockchain and really kind of um, reduce those functions in a bank or a brokerage because of this technology. But at the end of the day, you're not bringing any new investors to the table unless you know, unless you ease up on the accredited investor rules. Or, you know, what's going to happen is to get it accredited. Well, excuse me, not get it accredited, but to make it publicly available. You know, you whoever is doing it, whatever brokerage is doing it for some asset, they're going to have to go through the full set of costs. Um, you know, to, I don't know, hundreds of thousands of dollars to security attorneys and fees to the SEC and everything else involved. And all those costs are going to be added into the cost of the investment, you know, before it ever gets to the retail consumer. You know, it's a lot of your alternative assets, you know, things like real estate, private equity, private debt, um, infrastructure. I mean, things that have, um, you know, anything that basically falls outside your basic public stock and bond markets, you know, they typically carry a higher yield than your public stuff. And they carry a higher yield because, you know, you're taking on more liquidity risk. You're expected to have a greater understanding, a little bit more sophistication. And I mean, I think I would argue that the average retail investor doesn't really understand stocks or bonds either.
No, no, I promise you they don't. I mean, I think that's one of the reasons that, you know, mutual funds
Yeah,
were such a success, because it allowed people to diversify without having to understand stocks. And I think you also, you know, it's fascinating to me when I look at that. I mean, throughout my career, because, you know, I've got a background in finance, I've had employees who've come up to me at various points when, like, I had a couple who were in a car accident or something, and so they got a big settlement, and they showed up and said, "Well, what should we do with this money? You know, we don't want to go spend it. We want to be responsible. What should we do with it?" My answer
right.
was real simple: go buy the Vanguard S&P 500 and forget about it. You know, don't ever look at it again. Just put it in there and just let it go, because you're not investors. You're not going to want to be investors. You have other jobs, you have other lives. Just put that money in there. In fact, anytime you got extra money, put that in there too. And, you know, they were both in their mid 20s, late 20s, something like that. I'm like, by the time you retire, you're set, you know, but just don't touch it between now and then, and you'll be fine. And most people, you know, if they do want to invest, you know, then I, you know, I remember back in 2000, all the people that I was working with who were buying these stocks during the dot-com era and were thinking that they were the world's greatest investor. I'm like, no, you're just part of the irrational exuberance. So what's interesting here is tokenization. First of all, it probably allows you, because you reduce the transaction costs. This is just my observation, but because you reduce the transaction costs, it allows you to sell much, much smaller chunks, if you will, of the
Right.
asset, right?
Right.
Um, and so I can understand how you could argue the OCC shouldn't be regulating this, you know, as something that requires accredited investors, because, you know, they don't have to make accredited investor kind of commitments on capital.
Right.
True. But also true is the fact that the risk didn't change. It's the same asset. It has all the same risks, all the disclosures that have to be made, all the things
Hmm.
that in theory somebody should be considering. But as you just pointed out, in reality, most aren't.
Yeah. Yeah. I mean, uh, I've helped write some of those disclosure statements and like offering circulars and whatnot in a prior life. And, there's a tremendous amount of stuff there. And certainly the retail public, does not read the disclosure statements on their mutual funds or whatever that
Well,
they
if you
get.
did read them, you'd never buy it. I mean, that's just it, right? If somebody ever actually sat down and read all the disclosures, it's like, I mean, they may as well say, likely causes cancer. I mean, it just, yeah, the odds are nobody's going to, I mean, if you've decided that this is the thing you want to be in on because you think there's a lot of upside, you're going to ignore all those risks for the most part, unless you're a really rational investor. Um, and that's what hedge funds are. They've got teams of people to go research all this stuff. But I got to be honest with you, most people I have met, one of my more interesting insights in life that came to me quite by accident. I was at a meeting with a couple of friends who were both in sales, and while we were in this meeting, it was in their house at their kitchen table. Um, some kid knocked on the door selling subscriptions, and the husband got up and went to the door. And 20 minutes later, he still hadn't come back. And the wife said, I have to go get him. He's out there buying something. And so she went out there and she got him and she brought him back in and, forced him to kind of abandon that. And I looked at both of them like, that's something I don't understand. You're both in sales. You've been selling stuff your whole life. You know all the tricks that salespeople use. And yet you're going to buy something that, probably doesn't have value and certainly isn't worth what you're paying for it. How's that the case? And their insight just boggled my mind. Salespeople are the easiest people to sell to in the world because they love buying and selling. They love the transaction. They love the excitement, and they just want to do a transaction. They just want to do a trade. Whether or not it's a good trade is almost irrelevant, and that
That's
just boggles
funny.
my mind. But that is, in fact, probably a lot of people. I want to buy this because it looks like it's a big win. Tokenization is new. The blockchain is new. I can't tell you how many people I've met who bought Bitcoin who definitely cannot explain what it is.
Yeah. Yeah, fair enough. It's the buzz that it generates. So it's a new sexy toy that um, early movers want to get into.
Yeah.
Um, so yes, I totally agree with all that. And as we like to say, monkeys will monkey, and emotions come from a much more primitive part of the brain than does logic and reason. And particularly in
Yeah, but
times
when
of
I take a
stress.
big loss, that's a logic and reason thing that causes a big emotional reaction.
Yeah, yeah, absolutely,
Yeah.
absolutely. That's why um, when I first learned the efficient market theory, when I was in graduate school, I had a good laugh over that because the whole premise that, if we assume that investors are humans, and investors are rational, that doesn't quite compute.
Yeah. Yeah. It is interesting, isn't it?
Yes,
So,
it
I mean,
is.
this is, again, as we said, this is something that's moving us um, down the chain of having a more efficient market, which in theory should therefore lead to a better market, right? Because it's
Right,
going to be more efficient.
right,
Um,
exactly.
I do wonder though, well, I do wonder, like, there's that whole thing that, was it Trump Maldives is doing or something like that,
Yeah, 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 yeah,
World
yeah.
Liberty Financial,
It,
and they're going to
yes,
securitize and tokenize what loan revenue on interest. So now we're talking about, cats and tigers and strips and collars and crazy stuff like that, but just calling them a token.
it's not clear to me what it is. I mean, this is around a resort they're developing in the Maldives, and let's see. So it's Trump International Hotel and Resort Maldives is a flagship luxury hospitality development by Dar Global. Um, Scheduled for completion in 2030, the resort is set to feature approximately 100 ultra luxury beach and overwater villas. Um, The initial tokenized offering aims to provide eligible accredited investors, here we go again, with both a fixed yield and loan revenue streams from a prime Maldivian hospitality asset underpinned by a globally recognized brand. Through the loan interest payments, investors will therefore gain exposure to the underlying asset's performance, including both potential income distributions and the potential for certain profits upon any future sale within a regulated securities network. So
Sounds like
it's not,
securitization with a fancy name.
yeah, it is. I mean, it absolutely is. And it's done under Reg D and Reg S for, Reg S is for like non-US folks, non-US investors. And Reg D is accredited investors in the United States. Um, it, it it's not clear to me whether they are selling interest in this like it's a timeshare or whether this is the people buying the tokens are providing the development capital and they're going to receive a coupon and then some level of profit sharing. Maybe it's the latter, but it's not clear from the press release. But anyway,
Hmm.
this is something that is taking place. It says that this is being driven by Eric Trump. But then there's a disclaimer that says that the Trump organization, its principals and affiliates, are not the issuers, sponsors, promoters, or sellers of the tokens described herein. And it goes on and on. You know, that
Hmm.
Don and certain of his family members have an indirect economic interest through approximately 38% beneficial ownership of an affiliate of WLF Maldives Limited. So anyway, the press release is on Business Wire, and we'll drop it in the notes below the video once we get it posted. So if anybody wants to go look at it, but this is something that is happening now. I mean, this or recently. It doesn't. I don't have any follow up. This was posted on February 18th, so of this year. So this is something that's being done, but it's still very much in that accredited investor space. And my
Yeah.
point.
So I guess what I'm thinking is, I mean, just to kind of pause here and recap what we've talked about for so far, right? So we got tokenization. It's based on the blockchain, which
Yes.
basically means we have a distributed ledger, and each owner of the asset, well, of the token, and therefore the underlying asset, has a copy of the blockchain. They have a copy of the record. If they make transactions, the record gets updated. Um, and that happens through the blockchain technology. And so the digital ledger technology basically keeps it so that everybody's up to date at all times on who owns what.
Right.
And then the token is really just a window into an asset or some portion of an asset, more likely
Hmm.
some portion of most of the time.
Right.
And that eliminates a lot of the back office stuff that happens in investment brokers and broker dealers, and like making sure that we keep all the ownership of shares and things up to date. And what's fascinating to me is if you really stop and think about stock, you know, in in a company, if you own one share of Coca-Cola stock, you're
Yeah.
in their ledger, right, as an owner of one share of stock. Um, and so their corporate treasury is keeping track of all those things and doing all that. And this would allow you to maybe take one share and turn it into 1,000 tokens or something. And so you'd have 1,000 people, but because the blockchain's doing it, it's a lot easier to manage. What it doesn't do is change the underlying asset and the risk or gain associated with that asset.
Right.
But it is interesting to me that most of the offerings that are being talked about are things that the SEC is stepping in and saying have to be done as accredited investors because the underlying asset is very risky. And doesn't matter if you're doing it through blockchain or smoke signals, you're getting somebody to make an investment in something that's an inherently risky asset.
Hmm.
Um, and it makes me wonder, why are the inherently risky asset guys the first ones to adopt tokenization?
um, there's been a trend going on in the alternatives world for several years now where they're trying to access the liquidity that's in the retail market. And you see a lot of retail wrappers around things like private equity and private debt and things of this nature. And, one of the reasons that all of these things exist and are pursued by institutions that are able to invest in them is they've got higher yield than what's available in the public market. Part of the reason they have higher yield is because they've got greater liquidity risk as well as, you know, just greater risk in general. Um, and accredited investor or institutional investors, in theory, should have people working for them that are smart enough to evaluate those risks and make a decision that they think is going to be best for, whoever their constituents are, whoever they have a fiduciary duty to. Um,
Well, I mean,
when,
so, but I
when
mean,
Yeah, but let me finish. When you take these things that have a high yield and then you carve them down and you put them in something that's supposed to be safer to make it safer for the retail public, you're layering on all these fees, which drop that yield from what the institutional guy or girl is going to be able to get and what the retail guy or girl is going to get. So, that's the part of the story, part of the buzz is, hey, you get to go get access to, this private equity fund that you normally wouldn't be able to get access to. But, we've got to have these other steps and these other intermediaries, every one of which costs money, which impacts your yield. So if I'm just making numbers up, if your institutional private equity investor is getting 20% on an investment and you're buying a tokenized secondary offering after the point at which there's no more capital calls available, and you're going through a retail broker dealer and everything else, all the other legal fees and everything else are layered into it, maybe you're making 10. So a lot of that juice gets sucked out of the lemon along the way.
yeah. Well, and so, I mean, I think for institutionals, it kind of makes a lot of sense to, I mean, the value proposition around clearing and settlement getting faster and cheaper makes a lot of sense in institutional things. I'm thinking like commercial paper, repos, those kinds of instruments where it's just a huge, especially repos, right? I mean, because you're doing
Yeah.
that every day.
Yeah.
Um, the amount of work that goes into that, I imagine a lot of it's automated, but it's still, you got to get ultimately to the ledger, the main ledger, right?
Yeah.
Whoever it is that holds that ledger. And here you're distributing that so it goes a lot faster. That makes a lot of sense to me. That would reduce a lot of your intraday transactional costs, things like that. Um, so I can see where that comes in. What's interesting to me is most of these guys are offering this kind of stuff where they're selling that requires going to qualified investors.
Hmm.
I'm pretty sure that if they were able to get to a retail investor with that, they're not going to pass that savings on to the retail investor.
No, yeah, yeah, I agree. I think it's going to go to their bottom line. That's where it's going to go.
So, what about from a regulatory standpoint? I mean, you know, if you think about following the money as a regulator and trying to go find out what happened, who bought what, where, when, how, who sold it to who, I would assume that the blockchain, since everybody has a copy of every transaction, which, as a database guy, troubles me because that means that there's an awful lot of redundant data out there. But data storage is cheap, at least it used to be.
Yeah.
But in terms of that, I mean, does it help regulators in terms of being able to find this stuff, or is it a layer of obfuscation that's going to actually make their life harder?
I think it probably helps them because since the chain is publicly available. I mean, granted, any PII, I mean, what you're going to be able to get to is a wallet address, and then
Yeah.
the step is going to be able to go connect the wallet to an individual or potentially an institution. And early days. I mean, part of the whole idea behind Bitcoin was you were creating an anonymous currency that would prevent this from happening. But depending on your point of view, either fortunately or unfortunately, those days are long gone.
Yeah.
And um, my understanding is that it's pretty easy to find the owner of a wallet. It's not um, you're not going to be able to hide and do sketchy transactions on Silk Road anymore. If there's three-letter agencies looking for you or whatever your transactions are in the crypto world, they're probably going to be able to find you, and that's outside my skill set.
Yeah.
Just
But I
based
get
on
what
what
you're
I've
saying. It's
what I,
creating a record that's easier to search and find.
yeah.
Um, and it's so in theory it's easier. Um, just completely tangential, but one of the things that always gets me is election integrity. Why are we always arguing about elections in terms of who won or didn't win, and we're
Right.
counting votes, weeks afterwards? I mean, what if we use the blockchain to do that? Everybody had a copy of every vote, albeit anonymously. You wouldn't be able to go and argue that this person won or that person lost through a count of the votes that happened at the central ledger, which is I guess the canvassing board or the board of elections or whoever the hell actually counts the votes. Um, everybody would have a copy of it in their blockchain.
I think you've got a good idea there. I really do, and I think the powers that be will fight tooth and nail to make sure that doesn't happen.
Correct, because it's transparent, it's auditable, and it's accountable.
Yeah,
And I would imagine that's the last thing they want. But yeah, I
I
mean,
would agree.
kind of wish we were using tokenization, and blockchain technologies for that kind of thing, as opposed to just, figuring out ways to carve assets up into ever smaller pieces. Because again, if all the assets here are things that require you to be an accredited investor, I don't really see how this is a big winner.
Yeah,
Um, you know, I
that's
mean,
my point. That's totally my point. That one of the promise that gets bandied about all the time is this access to increased liquidity, which is going to come from the retail public. But if the retail public is banned from investing in these things, these offerings, then you got the same population of accredited investors that you had before. You have yeah, I think the banks and the brokerages are saving money on their back office now, but to your point, they're probably not going to pass that along any more than they
no,
absolutely have to, to remain competitive. And you could see a potential tightening of increase of what is offered from a yield perspective to investors as they try to outcompete to the extent that they do. But you're not increasing liquidity just by doing this. You're not. And I'm trying to find it. I want to talk about the Clarity Act a little bit
yeah, I just saw
because
some news this morning that that's been stalled um, for quite some time. But one other question I had in this while you're looking,
yeah,
what happens if somebody, you hear the stories about the person who has Bitcoin on a USB key and then they lose that key, and the guy who went and searched all the dumps, I think it was in England or somewhere, all the trash dumps looking for his USB key because it was worth $250,000 or something. What happens in that situation?
well,
It's interesting because you're on the blockchain. Everybody has it there that you're on the blockchain and that you own this. It's not like you can transfer it to somebody else. But
but
then
if you
how do you make sure that it doesn't get, that somebody to just claim a lost wallet and then you reissue the wallet and then they, sell it twice? I That's an interesting one.
yeah,
I mean,
I mean,
granted, again, most people probably have no clue like what goes on in the back office of a BD or an IB,
right,
and they just get a statement and they kind of assume everything's cool.
right,
But if you're talking about something that literally isn't online because it doesn't require access to everything else online,
right.
I wonder what happens when people lose these.
Well, I mean, there's plenty of stories out there about people that have done just that. They've lost their password and they are sitting on millions of dollars of Bitcoin, but they've used up all their tries to get into the wallet except the last one, and they're just unwilling to try one more time, because when they do, it's all over.
Yeah.
It's locked forever, or you put it in a hardware wallet and you lose the hardware. Yeah, I mean, it's lost. There's no way to get it back. Some of what we've looked at here when we were researching for this episode, that is one of the things that's out there. It's like a lost wallet provision that would need to be baked into the contract to begin with, to where if that happened, the old wallet would be burned and a new one could be recreated. But I don't actually know what the mechanics of that would be. But again, it's going to have to be at the outset of entering into the contract. That's going to be part of what would normally be in an offering circular, along with those risk factors. That would be
Yeah.
actually that would be another big risk factor. If you put it in a hardware wallet and you throw your hardware wallet in the dumpster, then you're hosed. So, but yeah, that's a great point. It's like,
I've
because
been hosed before, but hosed on something that's worth a lot of money is a whole different. I mean, it's mind-boggling to me that you could have that much money on a USB key, and there's really no backup system.
yeah, yeah,
That just wow,
that's
that one
that's
is
you go put it in a safe deposit box, or maybe lock it up in your gun safe at home, or whatever it is you have. But that's
yeah.
certainly not something you want to leave laying around.
Well,
Um,
that's another interesting question. Are these like bearer bonds? I mean, if you got a USB key with a bunch of tokenized assets on it, you got $1 billion worth of Starwood Hotel real estate
yeah,
assets or something, and you left it in your safe. I broke in your house and I stole it. Is this like a bearer bond? I got it, so I can.
that's a great question, because I'm not sure, because if it was $1 billion worth of Bitcoin or Ethereum, then yeah, it's a bearer bond. If they can access the wallet, they can drain you dry.
Yeah,
In the case of the tokenized assets that require whitelist identity verification and accreditation standard, verification. Maybe not,
yeah,
because if they're not on the list, as an accredited investor, an approved investor, and whatever the deal is, or whatever the exchange is, or what have you, then no, they're not going to be able to move it from your hard wallet into their wallet.
right, right. Hmm.
So, that's the I suppose from that point of view, that's one of the advantages of having, a permissioned um, blockchain with like centralized controls. Because I mean, the whole
Yeah,
original point was everything to be distributed and permissionless. But again, it's kind of as the Who said, meet the new boss, same as the
same
old
as the old
boss.
boss.
Exactly, exactly. Uh, Great song, by
We
the way.
won't get fooled again, though.
I think we're constantly being fooled over and over, but that's
Well, yeah, and it's interesting. It's usually the same con, just with different names and faces, and but the promise is always the same, right? Give me your
absolutely
money, and I will give you a big return.
yes,
Um, you know, and the irony is that the Ponzi scammers do give the first people a big return. So,
yes.
I've always wondered if you're the first person in the link of a Ponzi scheme. Are you guilty of theft? Even if you didn't know, it's interesting. Whole different discussion.
Yeah, yeah, we're not going to unpack that one today, but yeah, I think
Come on, we can fix that.
I think we need to have drinks in front of us before we try to unpack
Yeah,
that.
yeah.
Um,
I'm pretty sure that that those people have some plausible deniability.
yeah,
Um,
I think that's true.
so to get rich, what you really need is just somebody else dumb enough to start a Ponzi scheme. So they take the fall, and then you're the first investor. Apparently, that's all you need. So,
uh, oh, Sterling,
so Greg,
where
have you
will
ever
we?
thought about? Have you ever thought about starting a Ponzi scheme? Because
Where
I'll be your
where
first investor.
Where will we find those people?
I
Okay.
don't know. Yeah.
Y- Yes.
Apparently,
Yes.
they're not that hard to find based on what we've been told. So,
Well, certainly that's what the SEC would have you believe that, or
well,
the,
I don't think the SEC is wrong, but I would also tell you that I know an awful lot of accredited investors who are not good investors.
sure.
They buy into it because their buddy on the golf course told them this is the thing they should do, and they got the document. They never read it.
Yeah.
I had a buddy who was a very high net worth individual who would hand me these things all the time to read. And, I would open up, I would go to the assumptions and look at the assumptions. If they were unrealistic, I would just stop, just say, run, don't do this.
Yeah.
And that's because the reality is most of the time, if you read the disclosures, you wouldn't invest. And yet some people ignore that and they make a lot of money ignoring that, right? Because those risks don't come and get them. So that's all part of trading the absurd, right? Is high
It
risk, high
is.
return, another one of those axioms of finance. And the people who are taking the high risk are getting the high returns, but they're also getting the big losses when those happen.
Yeah, that's true.
Yeah.
Um, that is totally true. I want to, well, we talked a little bit, or I mentioned the Clarity Act, which is, let's see, Senate passed it 15-9 on May 14th. Now it's got to be reconciled with a companion bill from the Senate Agriculture Committee, then passed by the full Senate, then reconciled with a House version. Okay. There's a lot that goes into it. The two things I'll address is one is they've got a split between things that are blockchain native, so basically cryptocurrencies. If it only exists on the blockchain, it's a cryptocurrency. Yeah, I mean, whatever they call it, a network token, in their legal language. But it only exists on the blockchain, and
Right.
it will be regulated by the CFTC. So, which regulates commodities future trading. So, and they've got a reputation for not being quite as onerous as the SEC. So everything else, which they're calling an ancillary asset, where you've got a token that's value relies on something else,
Right.
whether it's entrepreneurial or a hard asset or something of that nature, something that we would basically call an investment, then it falls in the SEC's bailiwick.
Yeah.
Now, you've got a tremendous amount of money has been put forth by Super PAC that is backed by a bunch of different companies in the crypto space, and it amazes me. Let me see if I can find this real quick. It's 2024 election cycle. You had about 40.6 million put forth by this pack. It's called Fair Shake, and the biggest donors to Fair Shake, you've got Coinbase, Andreessen Horowitz, and Ripple are the three big ones, and then it drops off from there. Coinbase put in about over $69 million. Andreessen Horowitz put in 67. Ripple put in 45. And then you've got Jump Trading put in 15 million, and Jump Crypto put in another 10 million, and it drops off pretty
Yeah.
seriously from there. But significant dollars. So it just totally blows my mind how much they have put to work. And what's sort of interesting, we were talking about this before we started, but the biggest spend was 10 million against Katie Porter for the California Senate race because she's
Right.
notoriously anti-crypto. So the next biggest spend was 2.8 million for Michelle Steele, for a House seat in California. So anyway, it's just tremendous amounts of money are being brought to bear by the crypto industry for this Clarity Act. And you've actually got tension here because they are putting a tremendous amount of money behind this, whereas like their opponents, like the ABA, the American Bankers Association, I don't I closed the link, but they only spent about 3 million over the same period. So it's just amazing, amazing, amazing. And one of the things that, I'll lean on here that makes me continue to say that anytime a Politico uses the word investor protection, it's a dog whistle, is the Clarity Act's compromise on stablecoin yield. So the banks do not want crypto exchanges or whatever, custodians of crypto coins to be able to pay effectively an interest rate because they don't
Hmm.
want the competition there.
Yeah.
They, you know, if a crypto intermediary, I'll call it, because it could be a variety of different types of firms. If they pay an interest rate, they become subject to all the banking regulations on, that the banks have to put up with.
Ah. Okay.
So the banks are totally opposed to this. And the compromise that uh, was come up with, which apparently neither side is happy with, is you can't pay an interest rate, but you can pay like activity rewards, kind of like frequent flyer miles. So you got to do something with your crypto, maybe stake it, or which just means you put it up to back a miner, or it could be a number of different things. Maybe log in, check your balance, maybe answer a survey. It could be any number of things. But as long as you do these activities, you can be paid a reward for actively taking part in the ecosystem.
Right.
And lo and behold, your activity rewards. Wouldn't it be interesting if it would roughly come out the same as a market interest rate on a savings account?
Would be. I suspect
And
it probably will be. I suspect that's exactly what will happen, right?
right, and this is my point that the SEC doesn't care one whit about investor protection, because if they did, they would allow these crypto intermediaries to provide interest without all the smoke and mirrors and the gyrations and games here,
Right.
because it is in the interest of the investing public to have more optionality, to have more options and more
Yes.
competition in the I'll just broadly call it the banking space. Okay, so let them compete because that's good for the individual consumer. That's good for the average person. If the institutions have to compete with each other to get those deposit dollars, whether it's fiat or whether it's stablecoin, with the fact that you've got, well, in this case, is like most of the money is coming from the crypto side, and I don't know whether the banks are just complacent or they've spent so much over the years that they didn't have to add too much to it to keep their politicians in line.
Yeah.
um
Well, that's probably part of it.
yeah,
I mean,
but it's why outcompete when you can pay a lobbyist to buy a Congress critter to create barriers to entry to your competition.
yep. Well, do it all the time.
I know,
Um,
I know.
you got the North American Dealers Association is probably the greatest anti-competitive thing I've ever seen in the history of my life um, for new cars. So
Oh,
yeah, I
okay.
don't doubt for a minute that's going to be the case, and that makes me wonder. If I mean, what I really wish there was some mechanism where small, medium-sized enterprises that are always starving for capital,
Yeah.
especially working capital, could get access to public markets. Now, I mean, I guess you could argue that, you've got not GoFundMe, but what are the like Kickstarter and things like that.
Yeah,
Um,
but
but that's
yeah,
only for new ideas, is
right.
where they're aiming for. What about the guy who's an HVAC guy who could be doing 6 times as much business if he could find enough working capital to grow his business, but he can't find it.
Well, that's where the Jobs Act, with the creation of like Reg A Plus and Reg CF, it was supposed to do that. but and hopefully I'll have like a guest lined up for us here in the near future that knows a lot more about that than we do, that can speak to it at length. But that's what that was supposed to do. But you're still um, you've got tremendous amounts of tremendous expenses before you can make that happen. I mean, you can raise up to $75 million a year in Reg A plus, and then depending on what you're doing, you might be able to go lever that
Yeah,
because what you're going to raise is equity, most likely. I suppose you could raise debt through that too, but if you raise equity, then you can go lever it to increase, what you've actually got to work with.
right.
But the estimates that I've seen, you're about a $500,000 in between your fees to the broker dealer, because you've got to have a registered Reg A plus platform, as well as the securities attorneys, because they've got to prepare the paperwork that will be reviewed by the SEC. And then you're paying a marketing company unless you're doing all the marketing yourself. I mean, maybe
Well, if
if
you're
you
doing the marketing yourself, you're probably not going to get much response.
right, and it's
Yeah.
it's some of the two of the biggest successes in that space that I'm aware of. I believe it was the Green Bay Packers, sold themselves to their fans.
Yeah, well, they had some pretty good marketing though, in the form of a team that plays on TV once a week for 16 or 18 weeks out of the year.
Right, right.
Yeah.
So I actually think that's brilliant, and I mean, my hat's off to them. I think it's fantastic that they did that. Another one was, I believe it was Newsmax, which was last year. You
Oh
know,
yeah.
they successfully raised their full 75 million. And I mean, they had like newspaper ads and stuff out, and magazine ads and conservative magazines and things, and they also were able to successfully clear the market. Um, but I mean, those are two massive success stories. But it's not everybody that goes to market with that, is as successful. And Reg CF, which I think is capped at $5 million a year, um, these things allow you to, access the retail public. You don't have to be an accredited investor. But still, the estimates I've seen for that is still you're looking at like 150,000 bucks, for all the administrivia to make it happen. And your
Correct.
HVAC guy would be better off, just taking the 150 if he had it or had access to it and building his business, as opposed to trying to raise using this vehicle.
Yeah. No, it's
So
it's irrational that the people who have the greatest need for capital are the ones who have the hardest time getting it, and the people who have the least need for capital generally have the most access to the markets and methods. And the barriers to entry in terms of like the legal fees, I mean, that's what the SEC is doing, is
right,
basically creating barriers to entry um, under the guise of protecting people,
right.
specifically protecting, the everyday ordinary investor, who I would agree does need some protection, no question. Um, but I would also argue that an awful lot of those accredited investors need just as much, if not more.
Yeah, I mean, I don't disagree. I mean, they need. I come out more less that they need, they're handheld by, mommy SEC, than we need to revamp the educational system where people actually learn how to think and make
Yeah,
decisions.
yeah,
And maybe if you want to do something with this, you cap it. I believe there is a cap for like Reg CF. An individual, an unaccredited retail investor can only buy so much of a given deal in a year. So, that kind of forced diversification, I think, would be a way to go about it. So, so you don't put all your eggs in, whatever deal, deal du jour, whatever looks good, whatever's got the best advertising. So,
well, I think that for the rest of the topic, so to speak, around tokenization, there's a lot more detail to get into, right? We've
yes.
touched on the regulatory, we've touched on a little bit of the technology, um, but we've talked some a little bit about kind of what could go wrong, but we really got into detail on that. I think that's probably a worthwhile thing to look at. And then, how does that all tie into the prediction markets? That's an interesting one. I
Oh
feel
yeah.
like that's probably our next episode is, part two of tokenization is to go through and say, okay, let's parse this a little bit more and figure out kind of what are the challenges that exist and how are people going to overcome those, and also how do you get to market with this? I mean, that's the real question: how do you get to market? Because
Yeah.
if we're talking here and for entertainment and for understanding and education, but if the only people who can play in this space are the big institutionals, then this is more about, from a consumer standpoint, they probably don't need our help. From an institutional standpoint, they're fine. But for the everyday
They think
ordinary
they're fine.
investor, yeah, should they be looking at tokenization? Should they be buying into these deals, or should they be avoiding these deals? And I think maybe even come up with a roadmap for, well, what are the criteria to determine should I do this or not?
Yeah, that's a good idea. That's a good idea. Um, let's see. Out
Apparently,
of
I
the
tell people if they don't understand it, don't buy it.
yeah, yeah, right. Only one of those donors to that super PAC is public, and that's excuse me, that's Coinbase. And in looking at the prediction markets, you do have a few contracts out there as to whether this will get passed this year or not. Looking at the Coinbase chart, I didn't see a whole lot of movement around the time that passed that last hurdle in the Senate. So um, don't know. Maybe we'll dig into that the next time we talk. We'll pull up where the prediction market charts are, and we can look at Coinbase's charts. The other donors are all private, so we're not going to be able to get any information on that.
Yeah. Well, I still think it'd be a worthwhile thing to look at, to at least understand it. Yeah.
Yeah.
Cool.
All right.
So until
Yes.
next time, our
Yes.
intrepid investor friends, um, keep in mind that the market is, at the end of the day, it in the aggregate might be rational, but throughout the day, it kind of absurd at various points along the way.
Yeah. And anytime you hear the phrase investor protection, your skepticism should go up several notches. Okay.
And if you're a Douglas Adams fan of the Star Child trilogy, the
Hmm.
trilogy of four books, that starts with, well, I don't remember what the first one really is, but anyway, Restaurant at the Universe, Life, the Universe, and Everything.
Right.
All the books, probably the funniest laugh out loud books I ever read. It's weird when I can read a book and laugh out loud, and those are that kind of book. But the whole concept, the restaurant at the end of the universe, the improbability drive,
Oh yeah.
that was driving these things. I kind of feel like that's what's driving the market. It's just the improbability drive of people making irrational decisions, but somehow it all gets rationalized together in the aggregate.
Um, I wish I could attribute this properly. It's like someone said that man is not a rational animal; he's a rationalizing animal,
Yeah, I like
and
that.
that's back to our that falls under our monkeys will monkey category. And if you
Well,
like
either way,
laugh
we're
at
still animals. Yeah.
we yes, absolutely we are, and anybody that tells you we're not is delusional. And laugh out loud funny. Check out Christopher Moore.
Christopher, what's the last name?
Moore,
Oh,
Moore.
okay. Yeah.
He did three. He's written a bunch of books, but he did three that were kind of like takeoffs on Shakespeare. I think the
Ah,
first one may have been Fool, if I remember correctly, which was kind of a takeoff on King Lear. But
mm.
uh, absolutely brilliant, absolutely brilliant. He's got like a vampire trilogy as well. That's again, I would read this stuff on airplanes, and I would be laughing out loud, and people would be giving me weird looks.
People do give you strange looks if you laugh out loud while reading something on an airplane. I can vouch for that.
Yes.
Yeah, there's no question about that. Somebody else is in that category is Louis Grizzard. Some of his books are laugh out loud funny too, but
Oh,
God
okay.
rest his soul.
Okay.
All right. Well, until next time.
All righty, gang. Thank you. If you like what we're doing, please like and subscribe, and drop us a note. Let us know what you'd like to hear us talk about, and we'll do our best to dig into it and let you know what we think. All right. Until next time, take
Take
care.
care.